Hello guys, so welcome to this video. So the topic for this video here is where I will share the complete analysis about Pinduoduo. Yeah, so the team has taken around I think close to 1 month. Okay, deep diving, researching, and finding information about Pinduoduo. Yeah, so this video here will be separated, of course, into three parts. Because there's a lot to cover. You see, all right. So what we will learn, okay, throughout this video here. So we have separated into a few chapters so that you guys know what you will get. Yeah. First off, we will share about why we like Pinduoduo. Okay. And then we will go through their financial metrics, what attracts us, how is their performance. And then we will go through about their business model. Okay. Why they can grow that fast. Yeah. So we'll go through and then competitive advantage. Yeah. See how this business, okay, how do they protect their own business against other competitors? Okay. And then next, we want to see their growth factors because we want to invest companies that can continue to grow. So what are they doing currently so that they can continue to grow bigger in the future? And then lastly, okay, I will also reveal to you the current valuation of Pinduoduo. Yeah. So let's get started with these two topics first. Okay. Why we like Pinduoduo, and then we go through their financial metrics. Okay. So let's get started. Now, first, whenever we always want to research a company, we want to assess their financials. Why? Because we want to make sure that the company that we invest, are safe, right? And then it's not a very risky company where their financials are very messy. Yeah, because when we invest, we want to protect our capital. Right? So it's best to invest in a very good company. So let's go through the income statement. Right? So the first thing is, of course, we want to look at their total revenue. So when you see it like that, quite impressive. Yeah, because this company is growing really, really very fast. Okay, if you see their total growth, okay, every single year. All right, let's start from the recent one. Okay, they grow 97, 57%, 39%, and then somehow re-accelerated to 89% and then 105%. That's quite remarkable. Yeah. Okay. Besides looking at the revenue, we also want to see their operating income and net profit also, because there's no point if a company's revenue is growing fast. But at the end, when you go down, you see their bottom line, they're actually loss-making. So there's a bit, with that we don't want to look at. So let's go through their operating income and also the net income. Good. All right. There's a very positive trend. So despite earlier years, they are showing losses. Well, I think it's also very common for this type of software companies, where they need to spend, R&D, sales and marketing more, all right, in order to spread out their brand, get new customers and stuff. Yeah. But of course, if every single year a company keep on having losses, then of course that's not sustainable. But it's good to see that as of now, right, they have been turning profitable already. Since actually 2021 also. All right, and it's not just a one-time thing, but every single year, yeah, they have been very, very in a profitable range. So at this point, it's quite safe. Okay. So another thing that actually impressed us is their margins. Let me take a look for you. Okay, gross profit margin, operating margin, and net profit margin. Okay, I closed the other metrics so you can see it clearly. Now, this company has a very high gross profit margin. Okay, you can see they are ranging around 70, 60, 70, and 60 here. So it's a 60% to 70% range, okay, which is quite high. Yeah. And then not only that, all right, we can see that their operating margin and net profit margin is around the same. That's why it sticks together here. So previously, yeah, they were negative, but it's good to know that currently it's a very positive trend and they have been, positive for the past 3-4 years already. 3-4 years. Okay, and gross profit margin currently 61%, operating margin 26.2, and the net profit margin is 26.9. Okay, so it's a quite good in terms of their income statement. Okay, so next, after we look at the income statement, we need to look at their balance sheet. Okay, so why we need to look at balance sheet? Simple. We want to make sure whether this company, is it financially sound? Is it safe to invest? All right. We don't want to invest in company. Of course, very simple. You also don't want your life to have a lot of debt, right? A lot of debt, a lot of liabilities. It's very unstable. So we want to make sure when we open and see their balance sheet, they are solid, they are safe to invest. Yeah. So how do we look at that? Very simple. Let's go to the balance sheet. First, just straight go to compare their total assets and total liabilities. Now, at first glance, okay, latest one, safe enough. Okay, assets very high, total liabilities is less than half. And we also get to see their history. Okay, the history is that you can see that there is a trend, how the management run this company. Okay, they don't, make their liabilities very high always. Yeah, so you can see the assets keep on increasing every year. It shows also that this business, their asset gets bigger and bigger every single year, it means that this company's value is also increasing every single year. Okay. Then you want to dig even deeper to see whether this company, all right, can they, is a more financially sound. Okay. We use these two metrics. Okay. Here and then financial health, current ratio, and cash ratio. Current ratio and cash ratio. Okay, let's remove the other one. So as you all know, current ratio is where we take the current assets as compared to the current liabilities. So we can see here is 2.1 times. Okay, it shows what? It means that based on their current asset, which is assets that can be liquidated into cash in less than 1 year, that's why we call it current. They can cover their current liabilities, which is liabilities that needs to be cleared within less than 1 year. Okay, they can cover it 2.1 times. So that's something quite reassuring for us that this company, they can cover it more than 2.1 times. Now, look at their cash. Now, 0.4 may be not that good. Maybe not that good, all right? But here's the thing, here's the thing. That's because we are only taking their cash. But I've discovered that, for Pinduoduo, they keep their cash a lot in short-term investments here. Okay, can you see that their cash, if we compare the current liability, based on 7.6 billion, all right, is 0.4. So it's supposed to be higher than that. Okay, because their short-term investments here, I also treat it as cash because it can be immediately liquidated and clear off any debt is needed. Right? So the short-term investments here, perhaps treasury funds, okay, because there's so much cash, can earn interest at the same time. So their short-term investments here has around 25.7 billion. So let's say you take 25.7 plus 7.6, I think it's 33 billion. 33 billion. Yeah, so if you take their cash, okay, versus their current liabilities, total current liabilities, 33 billion divided by 20.8 billion, I think it's around 1.6 or 1.7, which is actually higher. So it's very good. Cash alone can already cover their total current liabilities. So this company is very safe. Okay. The next thing that really amazes the team okay, is when we look at their cash flow statement. Okay, when we go to the cash flow statement, what is the main reason why we want to look at cash flow statement? Simple. We want to see first whether this company, can they generate cash? They generate cash. Then secondly, we want to see whether this company can sustain themselves internally through their own business. Okay, and then third, we just want to see how high, okay, the quality of this business are. Yeah. So when we go to the cash flow statement, what do we look at? Very, very simple one. Just look at their cash from operation. Why? I just want to straight away go and see how much cash they generate from their own business operations. Yeah, the name itself speaks everything already. Cash from operation. Okay. Then after that, the next metric we want to look at is the free cash flow. Why free cash flow? Because after free cash flow's formula is operating cash flow minus capex, and then free cash flow. So capex is the capital expenditure, which means cash that is needed and spent on the company to maintain it or grow it. Right? That's capex. So if they can, after minus it, whatever that's left is called free cash flow, and the company can do everything with it. Okay, with free cash flow, whether they want to invest back in themselves, buy other companies, or put into the bank, they can do anything they want. Now, be prepared. Okay, be prepared, okay, to what I'm going to show you. Can you see what is this? It shows us that every single year that this company, number one, can increase their cash from operation every single year and increasing quite fast. And can you see their free cash flow here is around actually the same as their cash from operation? Simple. It shows us that this company has a very, very low capex. It's a very asset-light business. Very asset-light business. If you want to grow fast or maintain the business, they only need to, spend a little bit more. That's all. If you want to know how much their capex is, this is their capex. Here. So every single year, for example, they only need to spend a very small fraction, okay, from their cash from operation. Like quite recently, here 92 million, 82 million, and 80 million. So this company, for example, generate cash 15.7 billion, but they only need to spend 80.6 million for their capex, and they still have a free cash flow of 15.6 billion. So this company is quite remarkable, really quite remarkable. Okay, so in terms of financials, guys, Pinduoduo, it seems quite attractive so far based on quantitative analysis. Okay, the next thing is their valuation. their valuation is the one that compels us, to look at it even deeper, even further. You will always say we want to invest in the company, we want to invest when it is undervalued, right? Now, you see, if you look at their price now, it seems that, wow, okay, previously was 208, dropped to 30, 35, 38 range, and then continue to go back up to 160. This is the part, where people see the price alone that, wow, go up so high, so expensive already. Can it continue to go up? But you see, that's the thing here. If we compare with their multiple, okay, the valuation, how much the market is actually paying them, right? Their price to sales ratio currently is only around 5 times here, 5.14. The blue color one is 5.14. Okay. But if we take on the average, okay, for the past few years, okay, the multiple on average, the market was actually paying them around 10 times. So it means at this price currently, okay, around 140, 47, okay, sorry, 100, yeah, 143, right? Okay, it's actually only a price to sales ratio of 5 times, whereas the market is supposed to be valued at 10 times. So actually there is a potential 100% upside for this stock. All right. Now, so this is based on multiple alone, and it seems quite attractive and it seems undervalued. Okay. So of course, okay, this is just a qualitative side. So the next thing, of course, we need to look at, okay, is their what? Is their business model here. All right. And before I forget, I missed out something. So another thing that compels us to take a look at this company is this one, operating expenses versus revenue. So what does this mean? Very simple. Now let's go back to the numbers here. You see, for a company, in order to grow, right, they will definitely need to increase their operating expenses, right? Now, when we look at it like that, wow, it increases quite a lot, right? But if we compare to their total revenue, okay, actually, they are decreasing in their spending. So what do I mean by that? Okay, you can see from here, maybe you can't see it, right? But we look at this chart here, it can tell us a lot of story. See, previously, they need to spend more in operating expenses as opposed to their revenue. But as the years goes by, you can see the trend is going down. So it means that, yes, the operating expenses, you can see the red color, is increasing. Okay, it's increasing, but it doesn't increase as fast as the revenue growth. So if you compare it, okay, the operating expenses as to the total revenue, it's the percentages actually getting lower and lower. What does this tell us? It tells us that this company is getting more and more efficient and there is operating leverage. So they don't need to spend as much, okay, in order to grow the revenue. So this is a very positive trend, okay, for this business here. Okay, so for this video here is about why we decided to look at Pinduoduo and their financial metrics. Okay, hope you can see already their performance. So the next video, okay, we'll be talking about their business model. Okay, we want to understand further, why they can grow so fast. Okay, and then not only that, we'll talk about their competitive advantage. Okay, to see, whether this company here are there any factors, okay, they win, okay, or get better than their other competitors. And not only that, can they continue to grow? Right? Is there any space? Is there any runway for them to grow to get bigger so that in the future the share price can go up higher? And then I will go through with you their current valuation. What is the real price, okay, for Pinduoduo to see whether they are currently undervalued or overvalued. All right. So without further ado, guys, okay, if you like this video, okay, do click subscribe because on my next video, okay, I'll be talking about Pinduoduo again, okay, on their business model, competitive advantage, growth, and their valuation. All right. So hope you all enjoy this video. Thank you very much.